Repricing the world. That's what sharply higher rates mean for just about every asset class.
Starting in the mid-60s, you had an inverse correlation between bond yields and stock prices. Then you went for about a 25 year period where for most of the time you had a positive correlation. We're back in negative correlation territory.
We're seeing it in stocks.
My observation over, 40 years or so of watching equity markets is that they are keenly attuned to interest rates as a more direct transmission mechanism to equity prices, simply because interest rates are a discount rate on future cash flows.
We're seeing it in the drop-off in M&A activity as sellers come to terms with the new lower prices that buyers are willing to pay.
We're certainly beginning to see a significantly greater amount of activity. It hasn't manifested itself yet in announced transactions, but announced M&A for the first 6 months of the year was down.
And boy, are we seeing it in bonds.
We're more or less in the range for treasuries that we're going to see.
But perhaps no asset class has been hit harder by the jump in rates than real estate, and in particular, commercial real estate.
Financing is harder to get today because of concerns about real estate, and also buildings have to have strong cash flows to support the higher interest rates that are associated with financing.
Leaving investors to wonder whether now's the time to pick up some bargains or whether they'd be trying to catch a falling knife.
I think the banks in the U.S. will lose $250 billion in office over time here. And there's about $2 trillion of equity in the banks. So it's like a 10% hit to U.S. banking equity. But I really think the focus on losses in U.S. commercial real estate is going to be in the office sector.